Right, so we've seen Harry. Now we need to talk about some fractal cycles. Not too long though.
Get ready for a financial thrill ride. From RAF pilot to trader. Siam's journey is legendary. The worst trader for 6 years. He emerged with a jaw-dropping £422,000 profit in the 2015 Black Monday crash. He predicted the 2018 Bitcoin crash and dodged the 2022 market plunge. A market profit since 2013. Siam's foresight turned adversity into triumph. He's the office's #2 ranked Mario Kart player. Please welcome the man who turns market chaos into financial symphonies. Siam Kid!
Oh, thank you. So I'd like to talk about a pig farmer. There's a guy in the late 1800s called Samuel Benner, and he was he was a pig farmer basically. And in 1873, he lost everything. There was the stock market panic of 1873, and he lost everything and almost his farm. And oh, by the way, all the hand drawings you see today are done by me, professionally done, and that is a pig, by the way. And so what happened is he sort of went inside, like he just obviously lost everything, and then tried to come up with a plan. And I don't know what he was taking, but in the 2 years where he just went into full beast mode, he emerged and with a book, and it was aptly called Benner's Prophecies of Future Up and Downs in Prices. What years to make money on pig iron, hogs, corn, and provisions. I still don't know what pig iron is, but yeah, he wrote a book in those 2 years after losing everything. And the most fascinating thing of that book is that he came up with this little chart. And he basically, you've probably seen this has been around for decades. I've seen this like almost 20 years ago. But what's interesting is that it's eerily accurate. So I'm not going to spend too much time on this, but long story short, he has all of these weird fractals. Like they move in like 16, 18, 20-year cycles, then back to 16, 18, and then he has all sorts of different cycles. But the key things is that during these times here, that's when you should start taking profit from the markets. And then you have these random blow-off tops where you have big calamities. And he wrote this in 1875, by the way. He absolutely nailed the 1929 Great Depression. He nailed the tech bubble crash, and he nailed a few other sort of mini drops. And so obviously me being the great graphical editor I am, I tried to superimpose the S&P 500 into this. And I basically zoomed in and I tried to see, okay, how accurate really was this? And guess what? All of those ticks are great times to buy or sell. So if you went back in time and basically created the Benner tracker, you'd be up a fortune. If you were to buy and then sell and then buy, then sell, etc., you would have made an absolute fortune. So I thought that's pretty impressive. That's as predictions go in the financial markets, that's as good as it gets. And then obviously other people on the internet have tried to track this. Someone did an up-only one, so they didn't do any shorting, which is where you would have made a lot of the profits, but they basically said, right, at the beginning of each year where he said, time to go long, etc., it's done pretty well. And so far this year, he's up 17%. Not bad. And so obviously the things that I wanted to know is, well, okay, what made him, how the hell did he come up with this? Was he on shrooms? Was he on, whatever? I don't know. There's 4 key nuggets from his book. So the first one is that he says that cycles exhibit a recurring pattern. Well, yeah, we see that a lot in nature, really. We have the seasons, we have so yeah, it sort of makes sense. And there's other things on the charts which are also display recurring patterns, so that's fine. But the reason why he thinks there are recurring patterns is, I thought was quite interesting. He says that all cycles are controlled by natural forces. Things like natural factors, sunspots, weather patterns. Now, from a market perspective, that makes sense, because if crop yields are high, guess what? More things sell, and therefore there's more money, and there's more selling, and therefore that will eventually affect the markets. So that sort of makes sense. And I guess even when I first read sunspots, I was like, really? And then when you think about it, if you have sunspots, what does that affect? Crops. Actually, yeah, maybe looking at the stars can help. Third nugget is that he said, yeah, predictable. You can use these cycles to profit from it. And then the fourth one, they're not infallible. So, and this is the key thing which I always have in my brain whenever I'm looking at a cycle, some sort of pattern or a fractal, is that they are not a precise trading tool, okay? It's sort of a measuring stick, a rough guide of, okay, this is interesting. There is a probability that this cycle is correct, but what you mustn't do is just YOLO in and out of stuff based on a fractal which someone came up with 100 years ago, or a random YouTuber or someone on Twitter just posted a picture or whatever. And also, followers, the amount of one's followers doesn't necessarily equate to intelligence or efficacy on the markets and whatnot. So yeah, cycles are just, they're not infallible. And so I was curious about what I've said about the markets in the past, and I sort of did some digging back, and I found a presentation I did in 2019. And so if you see that, I've just put this yellow bit in the bottom just so you know if this is an old slide or not. And this was part of a presentation where I said there won't be a crash in the short term, but there's likely to be a crash in the medium term. And you know what? That presentation 2019, don't mean to pat myself on the back. It was pretty spot on. So the three main things is that, these are the reasons why people think we're due for a crash. Stocks crash every decade, they have to fall now, baby boomers are dying and or selling up, and every metric is showing to be way overvalued. And yes, I do agree with that. But the thing is, whenever you have a stance on something, the time frame of that stance is critical. My chronic curse is that I'm always early into something and I'm always early out of something, like 90% of the time. And I think all of you will, if you're not already in that curse, you will eventually get in that curse, because the more time you spend obsessing about something, guess what? You just know more about it than other people. And because your finger's on that pulse a lot more accurately than, say, the average Joe, guess what? You're going to see troubles, you're going to see trouble ahead, good times ahead, or whatever. And if you see an arrow coming towards your basket, you're going to jump out. But guess what? There's always that public lag. There's always that hype delay where you'll jump out, the market will then boom, everyone goes, huh, idiot, and then the market will tank. And so that's the curse, because I'm looking at crypto or investing just 100% of the time. I tend to spot things a lot sooner, and therefore my curse is I always get out a bit early, which is good and it's bad. So let's address this one. Stocks crash every decade. So I got a chart of the S&P 500, and obviously we have the 1929 Great Depression crash there. And what we can see is that, when we're exiting this sort of phase here in the 1950s, everyone back then was saying, oh, we've got massive unemployment, big debt, the market has been rising for over a decade now, it must fall. But what happened? We then had an explosive sort of decade where the market just absolutely pumped, or a decade and a half. And then guess what? We had a consolidation phase. So yes, the doomsdayers were correct. They were just 15 years early. And then we had another sort of, not only did we have a big crash here, we also had a silent crash, because so whenever a market's not rising and just going sideways or even down, there's a silent crash as well. So not only do you have a horrific collapse in prices, which obviously everyone can see as a crash, when things go sideways for the best part of 20 years, that's a silent crash, because don't forget, the currency supply is expanding by 15% per year. And therefore you go, okay, well, if my money's going sideways for 15 years, or 10 years or whatever, you're actually losing a huge amount. Someone's at the door. So guess what? People then say, oh, look, we have to fall now. Because it's rallied hard from 1980 to sort of the mid-90s. But guess what happens? We have another bunch of years where the market just explodes and then it crashes. So I guess if you're in that early curse, as I mentioned, you probably would have seen this going, oh yeah, now's probably a good time to get out because high debt, high unemployment, all that sort of stuff. But then hype takes over, and this was the tech bubble. So some brand new tech came along and just exploded onto the scene, which our lives wouldn't cope with without internet these days. And so what I was saying is that we've got the same sort of setup here. This was back in 2019 where everyone's going, yeah, all this stuff is still the same. And the next slide should be, oh no, yada, yada, yada. Yeah, this is me just putting times on it. Will there now be 135%-ish and a 9-year breakout ending in 2024, taking us to around 5,300? I wasn't far off. We sort of skimmed the 5,000 level. So yeah, that's not too bad. Now, so my answer to that is yes, there are sharp crashes, but no multi-decade bear markets for the moment. The other thing is that baby boomers are dying and selling up. So businesses are being sold at the fastest rate that humans have ever seen, because historically the baby boomers have been the biggest human demographic by a country mile, and they're all dying now, unfortunately. They're all 70 years old plus, and typically 70-year-olds and overs don't run businesses for that long, so they end up trying to sell the business to, for healthcare issues, all that sort of stuff. But normally that would be a massive factor, but because of tech also being exponential, the barrier to entry, the cost to set up a brand new business is so damn cheap. Right now is the easiest time in human history to set up a business from scratch. You can do it cheaper and 1,000,000 times faster than historically. So if a boomer's selling his or her business, it's like, well, yeah, I could buy your business. Effectively, you're just buying the list. Or can you just set it up from scratch, and then can you use marketing to acquire the same customer size than buy? So that's the risk to reward seesaw whenever you're buying business. Can you set up yourself, and can you acquire through marketing, whatever, the same size list cheaper than this, whatever you're buying? So and unfortunately, bad news for the boomers because exit prices are dwindling. And so I'm a big fan of demographics, and I've talked about this a lot. So for the RT people here, today there's going to be a lot of, not rehashed content, but stuff that you've probably gone, oh, I heard this already. But repetition is the mother of learning, so pin your ears back and listen. So we have these generations. So we have the greatest generation, that's a bit modest of them. The silent generation, they're silent because they've seen World War I and II, so they're just like PTSD galore. Boomers, Gen X, etc. And every website has a different sort of age bracket, but they're all around the same. So my answer to this was that the millennials, voila, is the biggest demographic on the planet by far. We surpassed boomers, was it 2016, 2018, somewhere around that. And the key thing with demographics is that you have a standard demographic spending wave. And again, I've done loads of YouTube videos on this before, but typically when a person or when a group of people hit the age of sort of 35 to 50, that's our peak spending typically. And yeah, so 35, that's where we start really getting into the peak spending. And that makes sense, right? Because we enter the workforce at 18 or 22, etc. You've been working for 15, 20 odd years. And so most likely by the time you're 35, 40, you're sort of at least manager level unless you've been flip-flopping jobs for all that time. But yeah, so guess what? You've got some spare disposable cash. And not only that, you've most likely got a small family. By the time you're 35, 40, you've got at least a small child or a couple of them, and therefore you've got lots of spending to do, nappies or kids' birthday. Oh my God, I go to at least 2 kids' parties every weekend at the moment. Spend my life just going to Smith's toy shops. Well, I used to, it's now Temu. So if you ever get a present from me, it's from Temu. So my argument there is, okay, well, you have to understand when is the peak spending area of each demographic. So here we go. And typically, just as a demographic heat enters peak spending, you get a bit of a sell-off most of the time. And again, with cycles and stuff like that, nothing's ever perfect, but most of the time you get a sharp sell-off and then a meteoric bull market. And think about it. Back in the 2000s, what was the tech that exploded? At the same time, Gen X hit peak spending. It was the internet. So you had Gen X at peak spending with literally a game-changing tech hitting the exponential curve, part of that hockey stick growth. And that's why we had, real prosperity from, really, economically speaking, from sort of the 2000s upwards. This is a logarithmic chart, by the way, so this doesn't look that great. But on a linear chart, it's like, whee! So guess what? Millennials have now hit, I'm 37, so like I'm a textbook millennial. I'm a gamer and all that sort of stuff. We are all hitting peak spending, or peak earning and peak spending over the next sort of 5 years. So I'm a firm believer that from sort of 2024 to 2030 are going to be really prosperous, other than a blip. And that blip will be some sort of market crash, because I do see a market crash coming. But overall, we've got this wild orgy of techs about to hit exponential growth and peak earning, peak spending, and the internet, and things are just much smaller because the internet makes the world smaller, so people learn things faster and all that sort of stuff. So I'm really bullish over the next decade, really, other than a temporary market dip. So yeah, boomers, who cares? Sorry. Sorry. Now, going on to this, I then said, despite the US debt to GDP ratios at an all-time high, it doesn't mean a crash will come because they control the printing. The world is basically falling into identical footsteps as Japan. Japan hit their highs in the early 1900s, and the stock market and the property market haven't breached those highs since. It's just been falling for, 1990s. That's like 30 odd years now. And so debt to GDP is a bit of a bullshit metric, because if you can control the money printer, it's irrelevant. You can just keep on printing more zeros until you hit hyperinflation. So what the US has done the Western world has done quite well for the last 20 years is sort of, they've been teetering on the edge of like big inflation and hyperinflation, and eventually something's going to break, like in Argentina right now, Venezuela, Lebanon, and all the other places. China and Japan are the biggest US debt holders, so it's in their interest that there isn't a crash, as the US will print. However, last cuddle, what did I talk about? The Bank of Japan being this Godzilla that no one is even aware of. Long story short, Japan are dumping US denominated debts right now. So they are rug pulling the whole financial market. The Bank of Japan is I would say, a good 60–70% of the reason why the equity markets around the world have been booming, because the BOJ have got they've had zero or negative rates for decades now, and they just print. And because they can't store their money in Japan, because they can't just because there's negative rates or zero, they're like, okay, where in the world is high interest rates? Oh, let's go to Australia because it's been around 4%, and they have to invest it elsewhere. So they've basically been the dealer of the world markets for best part of 20 years until now. Japan are like, sorry. They are literally rug pulling everyone, and no one sees this yet. But again, this is me being early. I can see this. I can see the bloody rearing head there. But I think it's going to be a little bit of time before that actually percolates into people's mental awareness, I guess. And the ticking time bombs. I think we've heard of this to death, but there are so many financial ticking time bombs. It is ridiculous. It's like trying to create a computer game, like The Sims, and trying to put in as many financial time bombs as possible and seeing which one explodes first. Except humans, in reality, whatever this simulation is, we're really good at kicking that can down the road. Now, I went into all of these back then. I'm not going to right now. I just want to share with you that these time bombs, hey, Virginia, these time bombs are still there. Nothing's happened. In fact, there are more ticking time bombs now than there were in 2019. And when you go into each one of these, it's just ridiculous. Like the energy junk bond world is insane due to the shale gas lunacy. And again, back in 2017, 2018, 19, I was singing from the rooftops that shale gas and oil is an absolute farce, and it's just the way that the oil companies are trying to, again, kick the can down the road. But the energy junk bond situation is, yeah, not just that. Student loan, auto loans. If you look at the delinquencies on auto loans, it is just spiking at the moment. Everyone's just literally, if a lot of people have cars on finance, they're just like, have the car back, please don't sue me, or please don't, come after the rest. The delinquency rates for auto loan, everything is going up. And yeah, it's nuts. I think in the US, the average student loan these days is north of $100,000. So most kids in America, they're going to uni, getting a bullshit degree of, I don't know, event management or whatever. Sorry. No shit, you've got an events management degree.
That was my first one.
Your first? Wait, how many degrees do you have?
2.
What was the other one?
A master's in construction project management.
Ah, there we go, that's a good one. Yes.
I didn't do events management because I wanted to party and leave.
Exactly. People are like, oh, what's the easiest, okay, not events management, Mickey Mouse bullshit degrees. That's what I meant to say.
It is Mickey Mouse bullshit.
Yeah, you just want to get drunk at uni, yeah. So, sorry if anyone has a Mickey Mouse degree. However, your second degree is relevant to your work right now, isn't it?
It was for the last job round, yeah.
Yeah. So, anyway, I'll get off my high horse. I never went to uni. I sort of, look, obviously you live vicariously through your uni friends when you're a kid, and yeah, but I never had that. I had the Air Force instead. But so this is what the public have done for eons. It's not just the millennials or boomers. This is just human nature, right? We live beyond our means. And by the way, this is not just individuals. This is governments as well. So this list I'm about to show you could be the US government, the British government. It doesn't matter. It's just humans. So these stupid bipedal chimps live beyond our means. We borrow. Why? Because we love that dopamine effect. We love, when something's fun or we buy something, the back of your brain just squirts a bunch of dopamine. It's very short-lived, it's got a short tail. But then our mental chimp goes, oh, I like that. Whatever gave you that little squirt, do that again. Or do whatever led to that, just do it again. And that's why we day trade. That's why people scalp. They're dicking around on the 5-minute chart or whatever. Whereas cortisol, opposite. It's got a very slow, long tail, and that's why people get depressed and all that sort of stuff. But anyway, we live beyond our means, and cheap rates facilitate that. Cheap rates are the drug dealer facilitating your stupid cognitive biases that we are as a race, a species are too weak to sort of understand. And so we borrow, we live beyond our means, and then something happens. The boiler breaks, car breaks down, you need to pay for something. But you've got no cash, so you have to resort to the lender of last choice, payday lenders. Thousands of percent APR. Then you have minimum interest only repayments. So what happens is that you're living on minimum interest repayments, but you're still doing the payday loans every week, every month to pay off, to just meet interest repayment obligations. And then something bad happens, like you lose your job, you lose your income stream, you lose something and that is when the lights turn out, literally. So basically you borrow until you can't, and then you go bankrupt or CVA and IVA, whatever you're doing, and then it's just, shit, restart level, just don't do that again. Now, the thing is, this is all very well and good when rates are low, right? What's happened recently? Now, this is not the Fed funds rate. This is not UK interest rates. This is the British mortgage rate, which in my opinion is the most important chart to look at when you're looking at personal finances. Because you look at the Fed funds rate or UK interest rates, they're a lot lower, but for you and I, it means nothing, really. But everyone bases stuff off the base rate. So lenders, like banks and mortgage lenders, what do? They look at base rates, they add on their premiums, right? What we get as the public is this, 8.01%. And that is a late paint, by the way. That's not up to date, because TradingView, sometimes it lags. But it's going to be around 8%. But that's average, right? There are other lenders that will be 10%, or they'll have their own risk profiles. And the reason the mortgage lending rate is so important is because this is where we live, folks, right? So whether you're renting or a house owner, it's irrelevant. If you're a renter, you think, oh, this has got nothing to do with me. It's got everything to do with you because you're living in a house that someone else owns, right? And if they have mortgage obligations, guess what? Their mortgage repayments are going up. What's that going to do to your rents? They're going to hike up your rent. So, of course, this matters to everyone. And even if you're fully mortgage-free, yes, you are somewhat insulated, but it affects everything else. Lending, full stop, just the markets, prices. Because if this goes up, guess what? Cost of living also goes up. So it still affects you, even if you're mortgage-free. And this is the fastest rate. Mortgage rates have gone up in a long freaking time. And so this is, we can see this. This is, the crash has already happened. We know there's people dead in that RTA, but the economy hasn't sort of, the first responders haven't come in and had a little nosy around yet. We can see this. We've seen this story all over the place, especially if you study history. That's why I'm a historian of money. I'm an amateur historian of money, because nothing changes.